This is a Best Syndication video production. Long-term care insurance policy information.
Long-term care insurance is a coverage which takes care of the policyholder where other insurance policies leave off. The policy is supposed to cover the costs that health insurance, Medicare, or Medicaid do not. As we get older, we are at an increased risk for illnesses or ailments that may require this kind of coverage. But since rates are determined in part by your health, it may be a good idea to protect yourself before you get older. A person may not even be sick to be covered, but may be unable to perform basic activities of daily living such as dressing, bathing, eating, toileting, getting in and out of bed or a chair, and walking. This coverage may also cover a person who takes a few months to recover from a surgery or illness. This may not even be what most people consider a long term, but may be also covered. But age may not be the determining factor for this insurance. About 40% of these receiving long-term care are between 18 and 64. For instance, the late actor Christopher Reeve, who was paralyzed in a horseback riding accident, required 9 years of long-term care. But he was not old. Neither was Michael J. Fox, who was diagnosed with Parkinson's disease at the age of 30. Medicare generally does not cover long-term care in the home setting, and Medicaid may not pay for assisted living. Since most people who need long-term care prefer to live at home, a long-term care package may be beneficial. The insurance may pay for care from day one of the illness. The insurance is intended to pay for the caregiver, companion, housekeeper, therapist, or private duty nurse up to 7 days a week, 24 hours a day. The policy may pay for assisted living, adult daycare, respite care, hospice care, and more. This could benefit the policyholder who suffers from Alzheimer's disease or dementia. There are other reasons why a person may want this coverage. Many older individuals don't feel comfortable having their children to take care of them. Without the long-term care insurance, out-of-pocket health care costs can quickly deplete a savings. You may be able to deduct the premiums of this coverage from your taxes. The amount of the deduction may depend on the age of the person covered. The benefits paid from long-term care coverage may also be excluded from your income for tax purposes. Check with your tax professional about deductions and find out what can be excluded from your taxes. There are different types of policies. The non-tax qualified NTQ policy, formerly called Traditional Long-Term Care Insurance, has been sold for over 30 years. This policy is triggered by the patient's doctor or doctor in conjunction with someone from the insurance company. The taxability of these benefits is open for interpretation and is still in question. The tax-qualified TQ policies do not have a medical necessity trigger. They may be triggered when a person is unable to perform 2 specified activities without assistance for at least 90 days. These activities may include eating, dressing, bathing, transferring, and continence. The doctor may also provide a plan of care. These payments or benefits are non-taxable. There are many tax issues involved in some of the packages, and it is advisable you seek advice before choosing the plan. There may be also local laws concerning restrictions on benefits in the tax-qualified policies. It is important to read the policy before signing. Once the policy is purchased, the language cannot be changed by the insurance company. Some group plans allow the insurance company to change the premiums. The policy might be renewable for life, and the insurance company may not be able to cancel it. There are 4 basic factors that will affect the rates: a person's age, the benefits, how long the benefits can be paid, and the health rating of the policy holder. The health ratings may vary from preferred, standard, and substandard. Discounts of 10 to 20% may be given to spouses. Legislation in California and other states may provide for a lifetime asset protection feature. The Deficit Reduction Act of 2005 makes the partnership program available to all states who want to participate.
This has been a Best Syndication News video production.